We're pleased to have with us Chad Karnes. He's Chief Market Strategist at ETFguide.com. He covers all the major ETFs, looking at the fundamentals, technicals, market sentiment, and he features that via a technical forecast that's updated twice a week. He's my colleague. I work with him at ETFguide.com. And Chad, welcome to the program. Always great to catch up with you.
Hey, thanks for having me again. It is a great time coming on here.
Well, let's talk about the U.S. stocks, which have been trading at all-time highs. At the same time, you would expect the VIX to be hitting all-time lows. Of course, the VIX measuring stock market volatility, also known as the fear indicator, but it hasn't really been hitting all-time lows. Talk about that.
Yeah, this isn't the first time. It's actually been a theme all year that when the S&P makes new highs, the VIX has not confirmed it by making new lows. Back in March is when the VIX set the yearly low around 11, and that was actually a 6-month low. But then in April, the market made new highs. The VIX did not make a new low below that 11 level. Again, in May, the same thing occurred. The market made new all-time highs, yet the VIX did not confirm by making a new low. August, September, and now again in late October, the same thing has been occurring. And when that happens, it's called, in technical terms, it's called a positive divergence. And what it basically means is that when you have two markets, such as volatility in the stock market, that should confirm one another, and one of them is not, it's usually a sign and can present an opportunity to profit from it, which we have done multiple times this year by buying the VIX whenever it's not made a new low, even though the markets have made a new high. And it's protected us from a lot of these little short-term tops that have been occurring. One other thing on the VIX that for the year anyways, it's when it falls below 13, which it did early last week, it's been below 13. It's been a very short time below it. So by buying the VIX whenever it gets down to 13 and keeping a stop around the 11 level, it sets yourself up for a good high probability trade that you can ride the VIX up to the upper teens, which has happened time and time again this year on about a 2-month cycle.
Chad Karnes, Chief Market Strategist at ETFguide.com, joining us. Let's talk about rising interest rates. Here we have another major investment theme that you have been right about. We've had you on the show before. You've talked about this. And I guess it's just another reason why people should follow market prices and not what the double-talking Federal Reserve says, because even with the Fed's attempt to keep interest rates low, we see the yield on Treasuries still jumping by more than 50% year over year. Talk about that.
Yeah, back in May, a key thing happened with Treasuries. They fell through a support level that had been in place since 2011. So their price had been rising, as everyone knows, the bond bull market. But then something happened back in May. Prices fell through a key level that had held for well over 2 years, and that was a sign that the intermediate uptrend was over. In our technical forecast, also back in May, we had our readers shifting out of the long duration bonds, which we use the TLT, which is an ETF that tracks the long-term Treasury. And then when it was around 116, we had people shifting into the shorter duration. And that saved them, year to date, that saved them about 8%, as it's fallen since then, and short-term Treasuries have remained relatively flat. And then in July, I spoke to Investors Business Daily about the recent shift in the trends, and how many economists, as you alluded to, they're actually trying to say that rising interest rates are good for the economy and a good thing. But when you look at history, it's not very. When you look at history, it just doesn't pan out. And sometimes I feel these guys, they never look at charts and they never look at history, because a steepening yield curve, which is when long-dated bond yields rise faster than shorter-dated bond yields, when that happens, it's been a very bad omen for the economy and the markets. That occurred in 1990, it occurred in the year 2000, and it occurred again in 2007, preceding all those recessions. And again, the curve has been steepening since 2012, and that's something I'm watching very closely. I like to play those rising yields is through an ETF called STPP, which tracks that yield curve, and it'll rise whenever the yield curve rises. So it'll protect you from rising interest rates. I also think that it's close to time to buy TBT, which is a leveraged short ETF that tracks the longer term bond prices. It's kind of the inverse of the TLT I alluded to earlier. I don't think the time is just quite there yet for TBT, but it should be right around the corner.
Chad Karnes, Chief Market Strategist at ETFguide.com, joining us. He covers all the major ETFs with a technical forecast updated twice a week. Go there, ETFguide.com. Gold is headed for its first yearly loss in 12 years, and gold bugs remain unconvinced that lower prices in gold or silver are ahead. What are the charts saying about gold?
Yeah, the gold bugs, they just refuse to admit defeat, and they're paying for it. On May 6th, on our homepage at ETFguide.com, there's an article that I did that shows one chart that I think the gold bugs should look at, and I don't think they are. And it basically questions, how can there be inflation if the dollar is actually getting stronger? And that chart shows that since QE started, which is the excuse that most of the gold bugs are using for this runaway inflation that's right around the corner, since that has started, the dollar's actually gained strength. And if the dollar's gaining strength, it's going to be extremely hard for gold and other commodities to be gaining in value. A dollar gaining in strength is actually deflationary, the complete opposite of what most of the gold bugs are using as their reason to continue to buy gold. Last time I was on the show, we talked about when gold broke below its 1550 level in April, and how we were on top of that and ready for it. And we've been banging the table on this deflationary scenario for years now, which is not that's not going to bode well for commodities, and so far it hasn't. I think gold's long-term trend, after a relief, which I talked about in July last time I was on your show, I think that relief may now be over. I think Friday's 1.5% down day may have put a stake in that, and I expect the longer-term trend, which is down, to now resume in full force.
You wrote an outstanding article at ETF Guide about how the Dow Jones Industrial Average has some major flaws hidden in plain sight. So what's wrong with the Dow?
Yeah, it's fairly complicated sounding, and you have to do a little math to see the real ins and out of it. But essentially, it's all because it's a price-weighted index. So the math on a price-weighted index works a lot differently than most of the other indexes, which are market cap weighted. So in particular on the Dow, the higher priced a stock is, the more it affects the Dow, the more weighting it has in the Dow, and the more significance it has in the Dow. So the recent shuffle that the Dow committee did was they removed 3 stocks which were very low priced. In fact, they were the 3 lowest priced stocks in the Dow in September: Alcoa, Hewlett-Packard, and Bank of America. And they replaced it with 3 very high priced stocks. 2 of those, Goldman Sachs and Visa, are now the 2 of the top 3 highest priced stocks in the Dow. So what that means is those 2 stocks are now as important as IBM, which was the most important stock in the Dow. So by just shifting out of those 3 lower priced stocks, they've shifted the weight and the meaning of the Dow top heavy to those higher priced stocks such as Goldman and Visa. So that's one part of it. The other part of it is the timing. And if you look back in history, the Dow committee is actually pretty horrible at timing. I did in a recent newsletter, I did a detailed look at this, but just as an example, it took the Dow committee until 1999 before they added Intel and Microsoft to the Dow. So only after both those stocks had risen, thousands of percent throughout the 1990s did they add them to the Dow. And again, it took them 4.5 years of a bull market before they decided to shift out of these lower price stocks and into these high flyers of Visa, Goldman, and Nike. And one of the things I talked about as well is this shift. If they would have done this instead of doing it in September of 2013, if they did it at the market lows back in March of 2009, the Dow would be 2,000 points higher today. And I think that just gives you an example of them doing one of the worst moves an investor can make by using past performance to try to predict future performance. They're the ultimate herd mentality, and they're making a crucial mistake here by adding these high-priced, high-flyer stocks after a 4.5-year bull market. Because if they think that they can rise on the upside, they certainly can fall quicker on the downside.
Yeah, that's some great points, and they've been notoriously late to the party for sure, the Dow Committee. We're just talking here with Chad Karnes, Chief Market Strategist at ETFguide.com. Go there. He covers all the major ETFs, does a technical forecast, updated twice a week. Chad, thanks for joining us. Great interview, and we'll catch up with you soon.
Thank you, Ron.
This is the Index Investing Show. I'm Ron DeLegge. More when we return. Go nowhere.
Show with DeLegge.